Synapse Global Institute. I am pleased to have you in this session of Financial Accounting 1, and I look forward to guiding you through the foundations of accounting that will support your success in the CPA program. As your instructor, my role is to help you understand accounting not as a set of rules to memorize, but as a logical system that explains how businesses record, analyze, and communicate financial information. Please remember that this is an interactive session, and I encourage you to actively use the chat section at any point to ask questions or seek clarification. We begin Chapter 1, Introduction to Accounting, and in this first segment, we will focus specifically on the nature and purpose of accounting. This section lays the conceptual foundation for everything you will study later in financial accounting, including double entry, financial statements, and analysis. Understanding why accounting exists and what it seeks to achieve will make the technical aspects much easier to grasp as we progress. Accounting can first be understood by looking at its nature. At its core, accounting is defined as the process of recording, classifying, summarizing, analyzing, and communicating financial information about an entity to users for decision-making. This definition highlights that accounting is not a single action but a continuous process that begins with recording transactions and ends with communicating useful information to various stakeholders. Because of this role, accounting is often described as the language of business, as it communicates the financial health and performance of an organization in a structured and understandable way. Accounting is considered an art because it requires professional judgment, skill, and discretion. Not all accounting decisions are mechanical or automatic. Accountants often make estimates and choices, such as selecting appropriate depreciation methods, determining provisions for doubtful debts, or valuing inventory at year-end. These decisions require experience, ethical judgment, and an understanding of the business environment, which is why two accountants may sometimes arrive at slightly different conclusions while still complying with accounting standards. At the same time, accounting is also a science. It is grounded in systematic methods, established principles, and internationally recognized standards such as IFRS and IAS. Accounting relies on evidence, documentation, verification, and logical reasoning. Transactions must be supported by source documents, recorded using agreed rules, and presented in formats that are consistent and comparable. This scientific nature ensures reliability and consistency across different organizations and reporting periods. Accounting is further described as a process that is systematic in nature. This process begins with recording transactions in the books of prime entry, where raw transaction data is first captured. The transactions are then classified by grouping similar items together, such as expenses, revenues, assets, and liabilities. After classification, the information is summarized through trial balances and financial statements. The next stage involves analyzing and interpreting the information to evaluate performance, liquidity, and solvency. Finally, accounting involves communicating this information to stakeholders such as investors, lenders, management, and regulators in a clear and meaningful way. Accounting is also a service activity. It does not exist for its own sake, but rather to serve users by providing information that supports decision-making, planning, and control. Businesses, investors, governments, and society rely on accounting information to make informed choices, allocate resources efficiently, and ensure accountability. Without accounting, economic decisions would be based on guesswork rather than evidence closely linked to the nature of accounting is its purpose. One of the primary purposes of accounting is to provide information that supports decision-making. Investors use accounting information to decide whether to buy or sell shares, lenders use it to assess whether to grant loans, and management uses it to determine whether to expand operations or cut costs. Accounting, therefore, plays a critical role in guiding economic decisions at both organizational and national levels. Another key purpose of accounting is stewardship and accountability. Management is entrusted with resources belonging to owners or shareholders, and accounting provides evidence of how those resources have been used. Through financial statements, managers demonstrate responsibility, transparency, and accountability for their decisions, which helps to build trust between management and owners. Accounting also ensures compliance with legal and regulatory requirements. In many countries, companies are legally required to prepare and publish financial statements in accordance with accounting standards and regulatory frameworks. These requirements support taxation, investor protection, and market confidence, and failure to comply can result in penalties or legal consequences. In addition, accounting supports performance measurement, planning and control, and comparability. It enables businesses to assess profitability, efficiency, and financial position using ratios and trends. It also allows users to compare performance over time and across firms within the same industry. In modern accounting, there is an increasing emphasis on credibility, transparency, and sustainability, with accounting information expanding beyond purely financial data to include environmental, social, and governance considerations. That brings us to the end of this first section on the nature and purpose of accounting. I encourage you to take advantage of the flexible Synapse learning model by pausing at this point, taking a short 5-minute break, and then returning refreshed for the next section. As you pause, feel free to reflect on what we have discussed, and please remember to use the chat section to ask any questions or share points that need clarification before we proceed to the next topic. As we continue with Financial Accounting 1 here at Synapse Global Institute, remember that you are encouraged to remain active throughout the session. Please continue to use the chat section at any time to ask questions, seek clarification, or share your thoughts. Accounting becomes much easier when concepts are discussed and connected logically. In this section, we move to the objective of financial accounting. This section builds directly on what we discussed earlier about the nature and purpose of accounting, and it explains who accounting information is prepared for and why that information is considered useful. Understanding this section is critical for CPA exams because many theory questions are framed around objectives, users, and decision usefulness. The primary objective of financial accounting is clearly set out in the IASB conceptual framework for financial reporting. According to the framework, the main objective is to provide financial information about a reporting entity that is useful to existing and potential investors, lenders, and other creditors when making decisions about providing resources to the entity. In simple terms, financial accounting exists to help users decide whether to invest in a business, lend money to it, or continue their relationship with it. This emphasis on usefulness means that accounting information must be relevant, reliable, and capable of influencing economic decisions. Financial accounting therefore focuses on 3 key areas. First, it provides information about the economic resources of an entity, such as assets, and the claims against those resources, such as liabilities and equity. Second, it explains changes in those resources and claims, which arise from income, expenses, gains, and losses. Third, it helps users assess the entity's ability to generate future cash flows, which is essential for evaluating sustainability and financial strength. Beyond this primary objective, financial accounting also serves several secondary objectives. One of these is stewardship and accountability. Management is entrusted with resources belonging to shareholders, and financial statements provide evidence of how responsibly and efficiently those resources have been used. While modern accounting places strong emphasis on decision usefulness, stewardship remains important because investors still want assurance that management has acted ethically and competently. Another objective of financial accounting is compliance with legal and regulatory requirements. Many jurisdictions require companies to prepare financial statements in accordance with specific laws, tax regulations, and accounting standards. Compliance ensures transparency, protects stakeholders, and helps organizations avoid penalties and reputational damage. In practice, this means financial accountants must be aware not only of IFRS but also of local regulatory requirements. Financial accounting also plays a key role in performance measurement. Through financial statements, users can assess profitability, efficiency, and effectiveness using tools such as return on assets, net profit margins, and gearing ratios. These measures help investors compare performance across different periods and across different companies, while management uses them to evaluate whether business strategies are working as intended. In addition, financial accounting provides a basis for planning and control. Historical accounting data is used to prepare budgets, forecasts, and strategic plans. By comparing actual results with planned figures, management can identify variances, investigate causes, and take corrective action. This shows that although financial accounting mainly serves external users, it also supports internal decision-making. Another important objective is comparability and transparency. Because financial statements are prepared using standardized rules under IFRS and IAS, users are able to compare financial performance over time and across different organizations. This comparability builds confidence in financial information and enhances trust in financial markets. In recent years, this objective has expanded to include corporate governance and sustainability, with increasing attention given to non-financial disclosures such as environmental and social impacts. To summarize this section, the objective of financial accounting is not simply to produce numbers, but to provide information that supports decision-making, accountability, compliance, performance evaluation, planning, transparency, and sustainability. Financial accounting therefore serves both external users, such as investors, lenders, and regulators, and internal users, such as management and employees. By meeting these objectives, accounting underpins trust and effective governance in business. At this point, I encourage you once again to take advantage of the flexible synapse learning model. Please pause the session, take about 5 minutes to rest and reflect on what we have covered, and feel free to post any questions in the chat section. When you are ready, press play to proceed to the next section, where we shall examine the elements of financial statements, which form the building blocks of all accounting reports. In this section, we now focus on the elements of financial statements. This topic is extremely important because it introduces the basic building blocks used to prepare all financial statements. If you clearly understand these elements, you will find topics such as double entry, trial balances, and financial statement preparation much easier to follow. Financial statements are designed to present a true and fair view of the financial position and performance of an entity. According to the IASB conceptual framework for financial reporting, there are 5 key elements that form the foundation of financial reporting. These elements are assets, liabilities, equity, income, and expenses. Together, they provide the structure for preparing the statement of financial position and the statement of profit or loss. We begin with assets. An asset is defined as a present economic resource controlled by the entity as a result of past events, from which future economic benefits are expected to flow. This definition highlights 4 important ideas. First, an asset must be something valuable. Second, the entity must control it, meaning it has the right to use the resource and obtain benefits from it. Third, the asset must arise from a past event, such as purchasing equipment or receiving cash from customers. Finally, the asset must be expected to generate future benefits, such as cash inflows or services. Common examples include buildings, machinery, inventory, receivables, and intangible assets like patents and trademarks. Assets are recognized in the financial statements when it is probable that future economic benefits will flow to the entity and when the asset can be measured reliably. Depending on the nature of the asset, measurement may be based on historical cost, fair value, or amortized cost. This recognition and measurement process ensures that assets are neither overstated nor understated, which is critical for reliable financial reporting. The second element is liabilities. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. Liabilities arise when a business has an obligation it cannot avoid, such as paying suppliers, repaying loans, or settling tax obligations. The obligation may be legal, arising from contracts or laws, or constructive, arising from established business practices. Examples of liabilities include trade payables, bank loans, tax liabilities, and employee benefit obligations. Liabilities are recognized when it is probable that an outflow of resources will be required to settle the obligation and when the amount can be measured reliably. They are usually measured at the amount expected to be paid, sometimes adjusted to present value where timing is significant. Understanding liabilities is essential because they represent claims by outsiders against the resources of the business. The third element is equity. Equity represents the residual interest in the assets of the entity after deducting all liabilities. In simple terms, equity is what belongs to the owners once all obligations have been settled. It is not an obligation, but rather the owner's claim on the business. Examples of equity include share capital, retained earnings, and reserves. Equity is important because it acts as a buffer for creditors and shows how much of the business is financed by owners rather than outsiders. The fourth element is income. Income represents increases in assets or decreases in liabilities that result in an increase in equity, other than contributions from owners. Income can arise in two main forms. Revenue comes from the ordinary activities of the business, such as sales revenue or service income. Gains are other increases in economic benefits that do not arise from ordinary operations, such as profits on disposal of assets or fair value gains. Income is recognized when it is earned, measurable, and when it is probable that economic benefits will flow to the entity. The final element is expenses. Expenses are decreases in assets or increases in liabilities that result in decreases in equity, other than distributions to owners. Expenses include operating expenses such as salaries, rent, and utilities, cost of sales in trading businesses, finance costs such as interest, and losses such as impairment or disposal losses. Expenses are recognized based on the matching principle, meaning they are matched to the income they help to generate within the same accounting period. These 5 elements are closely connected. Assets and liabilities are presented in the statement of financial position, while income and expenses are reported in the statement of profit or loss. Equity links the two statements by showing the residual ownership interest. This relationship is captured in the accounting equation, which states that assets equal liabilities plus equity. Understanding this relationship is fundamental to all accounting work. To conclude this section, financial statements are built on 5 essential elements: assets, liabilities, equity, income, and expenses. These elements ensure that financial information is structured, comparable, and meaningful to users. A solid understanding of these elements will greatly improve your ability to analyze transactions and prepare accurate financial statements. At this point, I encourage you to take advantage of the flexible Synapse learning model. Please pause the session, take about 5 minutes to rest and reflect, and feel free to post any questions in the chat section. When you return, press play to proceed to the next section, where we will examine the accounting equation, which formally links all these elements together. In this section, we focus on the accounting equation, which is the backbone of financial accounting. Every accounting record, from the simplest cash transaction to complex financial statements, is built on this single relationship. If you understand the accounting equation clearly, you will understand why accounting uses double entry and why financial statements must always balance. The accounting equation expresses the relationship between a business's resources and the claims against those resources. It is stated as assets equal liabilities plus equity. Assets represent what the business owns or controls, liabilities represent what the business owes to outsiders, and equity represents the owner's residual interest. This equation must always remain in balance because every resource owned by a business is financed either by borrowing from outsiders or by contributions from owners. Assets include items such as cash, inventory, buildings, equipment, and receivables. These are the economic resources that enable the business to operate and generate income. Liabilities include obligations such as trade payables, bank loans, and accrued expenses, which represent claims by external parties. Equity represents the owner's claim after all liabilities are settled and includes capital introduced and retained earnings. Together, these 3 components explain the financial position of a business at any given date. One of the most important implications of the accounting equation is that every transaction has a dual effect. This is the basis of the double entry system. When a transaction occurs, at least 2 elements of the equation are affected in such a way that the equation remains balanced. For example, when an owner introduces capital in cash, assets increase and equity increases by the same amount. When a business takes a loan, assets increase and liabilities increase. When expenses are incurred, equity decreases, while assets decrease or liabilities increase. The accounting equation can also be expanded to show how income, expenses, and drawings affect equity. In expanded form, assets are equal to liabilities plus capital introduced plus revenue minus expenses minus drawings. This expanded version helps to link the statement of financial position with the statement of profit or loss. It shows clearly that profit increases equity, expenses reduce equity, and drawings reduce the owner's interest in the business. To illustrate this, consider a sole trader who starts a business by contributing cash. Assets and equity increase equally. If the business then buys equipment for cash, one asset increases while another asset decreases, but total assets remain the same. If the business takes a loan, both assets and liabilities increase. When sales are made at a profit, equity increases through retained earnings. In every case, although individual balances change, the accounting equation remains in balance. The accounting equation is fundamental for several reasons. It explains why accounting uses the double entry system, where every debit has a corresponding credit. It provides the structural basis for the statement of financial position, ensuring that assets are always equal to the total of equity and liabilities. It also acts as a built-in accuracy check, because if the equation does not balance, errors have occurred in recording transactions. From an examination perspective, the accounting equation is frequently tested in CPA foundation papers. Students are often required to show the effect of transactions on assets, liabilities, and equity using tabular formats. Practicing this approach helps you visualize how transactions flow through the accounting system before they are recorded in ledger accounts and financial statements. To summarize this section, the accounting equation states that assets are financed by liabilities and equity, and it must always balance. Every transaction affects at least two components of the equation, which is why the double entry system works. The expanded equation shows how income, expenses, and drawings affect equity, linking performance to financial position. A clear understanding of this equation is essential for accurate accounting and financial reporting. At this point, I encourage you once again to take advantage of the flexible Synapse learning model. Please pause the session, take about 5 minutes to rest and reflect on what we have covered, and feel free to post any questions in the chat section. We now focus on the users of accounting information. This topic explains who relies on accounting information and why that information matters. In CPA examinations, questions in this area often test your ability to link specific users to the type of information they need and the decisions they make. Accounting information is prepared not only for management but for a wide range of stakeholders who have an interest in the business. These users are broadly classified into internal users and external users. Each group uses accounting information differently, depending on its objectives and relationship with the organization. Because of these differing needs, financial reporting must aim to be fair, reliable, and relevant to all users. We begin with internal users, who are those within the organization. The most important internal users are management. Management uses accounting information for planning, controlling, and decision-making. This includes preparing budgets, forecasts, and performance evaluations. Unlike external users, management often requires detailed and timely information, sometimes on a daily or weekly basis, to monitor operations and take corrective action where necessary. For example, management may analyze cost reports to decide whether to reduce expenses or invest in new equipment. Another group of internal users is employees. Employees are interested in accounting information because it affects their job security, wage negotiations, bonuses, and career prospects. Profitability may influence salary increments or bonuses, while expansion plans reflected in financial results may create new employment opportunities. Employees therefore use accounting information to assess the stability and future prospects of their employer. We now turn to external users, who are outside the organization but still rely heavily on accounting information. One key group is investors, both current and potential shareholders. Investors use financial statements to assess profitability, dividend potential, and long-term growth prospects. They analyze ratios such as earnings per share, return on equity, and dividend yield to decide whether to buy, hold, or sell shares. 4. Investors, accounting information reduces uncertainty and supports informed investment decisions. Another important group of external users is lenders, such as banks and other creditors. Lenders are concerned with the entity's ability to repay loans and meet interest obligations. They focus on liquidity ratios, solvency ratios, cash flows, and gearing levels. Before extending credit or approving loans, lenders carefully examine financial statements to assess risk and repayment capacity. Government and regulatory authorities also rely on accounting information. Governments use financial statements for tax assessment, monitoring compliance with laws and regulations, and formulating economic policies. Regulatory bodies such as revenue authorities and capital market regulators depend on reliable accounting information to protect public interest and ensure market integrity. Compliance with accounting standards and reporting requirements is therefore essential for legal and regulatory purposes. Suppliers and trade creditors use accounting information to assess whether a business can settle its debts when they fall due. They are particularly interested in liquidity and working capital positions. A supplier deciding whether to offer goods on credit will examine financial statements to evaluate the risk of non-payment. Similarly, customers may be interested in the financial stability of a business, especially where long-term contracts, warranties, or after-sales support are involved. Finally, the general public and society are increasingly recognized as users of accounting information. Members of the public are interested in issues such as corporate social responsibility, sustainability, environmental impact, and ethical behavior. Financial transparency helps build public trust and supports accountability, especially for large organizations whose operations significantly affect the economy and society. Because these user groups have different and sometimes conflicting interests, conflicts can arise. For example, investors may prefer high dividends, while lenders prefer profits to be retained to strengthen solvency. Management may focus on expansion, while employees may prioritize higher wages. Governments may seek higher taxes, reducing profits available to owners. These conflicts mean that accounting information must be prepared in a neutral, balanced, and objective manner, guided by accounting standards and ethical principles. To summarize this section, accounting information serves a wide range of users, both internal and external, each with different objectives and information needs. Management, employees, investors, lenders, government, suppliers, customers, and the public all rely on accounting data to make informed decisions. Because of potential conflicts among users, financial reporting must be relevant, reliable, comparable, and transparent. As we come to the end of Chapter 1, I encourage you to take a moment to reflect on how the different users of accounting information influence the way financial statements are prepared and presented. This reflection is important because it ties together everything we have covered in this chapter, from the nature and objectives of accounting to the elements of financial statements, the accounting equation, and the diverse needs of users. Thank you for your engagement and focus in this class. When you return, we will proceed confidently into Chapter 2, where we begin examining the accounting process and systems in greater practical detail.